Hi, my name is Whitney Townsend, and I'm a mortgage loan officer here at Fort Community Credit Union. Today we're going to be talking about the process to financing your first home. We're going to talk about what kind of goals you can set and a realistic timeline to purchasing your very first home. So let's get started. So where do you start when you're interested in financing a home? Well, first, you need to define your goals. Do you want to purchase a home in the next 5 years, in the next year? The second step is to really think about where you want to live. What's the cost of living in the area where you want to purchase a home? Next is what kind of features are you looking for in a home? Is it 2 bedrooms, 1 bath? Is it 3 bedrooms, 2 bath with a pool in the backyard? You really need to think about what your ideal home looks like and define and write down those features that you're looking for in a home. The next step is to think about how much home you can afford. Think about the monthly rent that you're paying right now and determine if that is an acceptable monthly payment for you. Is it workable in your budget? That will help us determine how much home you can afford on a monthly basis. And then the final step is deciding what is a realistic timeline for you to get the money that you need for the down payment and closing costs. It's important to be realistic about this so that you don't set expectations that aren't doable within the timeline. The next step is to determine the cost of buying a home. So there's a lot of different things that you need to determine in how much money you have to save for that home. So the first step is how much money are you putting down? A lot of traditional conventional loans require 10 or 20% down. There's different government programs that offer as little as 5% or even 3% down. These programs, though, are income dependent and will be determined by your qualifications as the borrower. So you have to look at how much money are you putting down? What is the sales price of the house that you're looking for? And that will help you determine the total cost in purchasing that home. So there's a great tool online through Bonsai called a mortgage affordability calculator. With this, you can enter in the projected monthly payment that's workable for you within your budget, and then from there it'll help determine what the purchase price is of the house that you can afford. So it's really important that when you apply for a mortgage that you know what you can offer as a down payment. This will help your lender in determining how much house you can afford and what's a realistic timeline for you in purchasing the home. Another factor in determining how much house you can afford is your total monthly debts compared to your total monthly income. This is referred to as your debt ratio. Now, we can't have you spend 100% of your income on all of your debts. How would you buy food? How would you buy all those other things that you're going to need once you have a home, like affording your energy bill and all those other things? So it's really important to keep in mind that you don't want to spend 100% or even 50% of your total monthly income on fixed expenses. So your mortgage lender will help you in determining how much house that you can afford based on your income and based on the other debts that are on your credit report. Things that factor in are like auto loans, student loans, revolving payments on credit cards. All of those debts are fixed on a monthly basis and will determine how much house that you can afford. So another great tool on Bonsai is how much mortgage can I afford? So this tool will take you through step by step all your monthly income, all your monthly expenses, and then help you determine how much house that you can afford based on the monthly mortgage payment. Let's check it out. So in this Bonsai coach, it's going to help you determine how much mortgage you can afford. It's important to note that just because you qualify for a certain amount of a mortgage, that doesn't mean that it's the best option or fit for you. So let's determine what is your ideal monthly payment. So first we're going to enter in what our monthly income is after taxes. So we're going to plug in $3,000. Just for an example that we'll do together. I encourage you to try this out at home, visiting our fortcommunity.com website and clicking on this Bonsai coach. Next, we're going to enter in our total monthly expenses. So we want to factor in all of the monthly expenses that are included on our credit report. So we're going to also enter in things like groceries and household items as well, because just because you purchase a home doesn't mean that these expenses go away. In fact, some of these expenses might go up. So we're going to enter in $800 a month in groceries, cleaning supplies, and etc. Car and transportation. For this individual, it's $100 a month on gas and insurance. Utilities is $150 a month. We don't have any child or family expenses. And then entertainment. So it's really important that you factor in how much money that you spend on entertainment, because you don't want to be what's called house poor, which means that you buy a house but you can't do any of the things that you usually enjoy. So we want to make sure that we don't include our current housing expense, because whatever we're paying in rent right now is going to go away once we move into our new home. So because this person has a car payment of $200 a month, we want to make sure that we factor that in because that car payment's not going to go away once we buy the house. So that means that right now, this person has $1,700 left over to allocate towards a housing expense after all the normal debt obligations are paid on a monthly basis. So it's important to factor in that you don't want to spend a lot of your income on your housing expense because all those other debts are not going to go away just because you purchased a home. In fact, some of those debts might increase, such as utilities or transportation costs. So for this individual, their ideal monthly mortgage payment is $750 per month. This is a really useful number that then you can bring into your mortgage loan officer and tell them what your current monthly expenses are and what your ideal monthly mortgage payment will be. So I invite you to use all these different resources that are available to you online. All of our mortgage loan officers are just a phone call away, so please reach out to us if you have any questions or concerns. So there's a lot of different mortgages that are available, and these are different loan products depending on what type of eligibility you have as the borrower. So there's a conventional mortgage. This is anywhere from 20%, 10%, or even that 5 and 3% down program. So a conventional mortgage might be a great fit for you depending on your qualifications as a borrower. So there's fixed rate mortgages, which means that that interest rate is fixed through the lifetime of the loan. So for example, if you have a 30-year mortgage, 360 months, and an interest rate of 3%, that 3% interest rate would be fixed. It would stay the same for the lifetime of the loan. The next type of mortgage is an adjustable rate mortgage. So in this type of mortgage, if we're doing a 30-year loan, it might be fixed at, let's say, 3% for the first 3 years, and then adjust thereafter to whatever the prime interest rate is at that time. So an adjustable rate mortgage means that that initial interest rate is going to change after whatever that initial period is. So you should anticipate an adjustment in your monthly mortgage payment after that initial period. The next type is a government-insured mortgage. So these type of loans, like USDA or FHA loans, will depend on your qualifications as a borrower. We can help connect you to these different programs depending on your eligibility. And then finally, a jumbo mortgage. These type of mortgages are dependent on the purchase price of the home, your down payment, and then finally the loan amount. There's an upper limit to what's considered a conventional mortgage. Any dollar amount above this upper maximum is considered a jumbo mortgage. Your mortgage lender can help determine which loan program is best for you. So Fort Community Credit Union has a lot of different tools available to you to help determine what kind of loan program you're eligible for, what kind of interest rates that you can expect, and then different tools to help determine what that monthly payment would be. So let's visit fortcommunity.com to see which resources are available to you. Fort Community Credit Union has a special page just for our mortgage loans to help you determine which mortgage program is right for you and what kind of interest rates that you can anticipate. You can apply online for a loan and be contacted by one of our mortgage loan officers to help you step by step through the process. On our website, we have all the different loan programs that we offer to our members, including fixed rate financing, land loans, construction loans, and second mortgages. By clicking on our rate center, you can look at what the current interest rates are for both 15, 20, and 30-year mortgages, and then you can zero in on the specific monthly payment that might work in your budget. So by visiting our home mortgage center, you can sign up for Rate Watch. You'll get an email either daily or weekly when that interest rate is within the threshold that you're interested in applying for. So if you're interested in purchasing a home, we encourage you to visit our website, apply online, and meet with a mortgage loan officer. We can help you step by step through the process of purchasing your home. Whether you are just setting the goals for when you want to purchase your home, interested in the different programs that might be available to you, or helping connect you to the resources that you're eligible for. We want to help you every step of the way. If you have any questions, please contact us online, by phone, or visit our website, and we'll reach out to you. Thank you so much.